Bang Si-hyuk built HYBE, the powerhouse behind BTS, into a multi-billion-dollar empire, and then took it public in a blockbuster 2020 initial public offering. But before the listing, early investors were allegedly told no initial public offering was planned, and they sold their shares for a fraction of what they would soon be worth. The estimated profit from that mismatch was $136 million. And what followed is a scandal no one saw coming. Bang Si-hyuk's story began far from the glare of global headlines. In February 2005, after years working behind the scenes as a songwriter and producer, he founded Big Hit Entertainment with just $100 million in capital and a handful of early backers. For years, the company scraped by on modest album sales, signing acts like Seungyu and 2AM, but never breaking out of the crowded K-pop field. That changed on June 13, 2013, when BTS made their debut. Within a year, BTS's album sales pushed Big Hit's revenue to 275 billion won, nearly doubling the previous year's total. Bang called BTS the growth engine of his company, and the numbers told the same story. By 2017, BTS was on the Billboard stage in Las Vegas, collecting the Top Social Artist Award and drawing international attention not just to the group, but to the label behind them. As BTS's fame exploded, so did Big Hit's ambitions. The company launched Weverse in January 2019, a fan community platform that blended exclusive content, social networking, and e-commerce. Weverse quickly reached 10 million monthly active users, driving new revenue streams beyond music. Strategic acquisitions followed, including Source Music and the gaming startup Superb, all funded by a 300 billion won private placement led by heavyweight investors like Miri Asset Daewoo and Samsung Securities. By 2019, Big Hit's annual revenue topped 1 trillion won, with 70% tied directly to BTS albums, tours, merchandise, and digital content. In October 2020, Big Hit went public on the Korea Exchange, raising nearly 1 trillion won and instantly transforming into a multi-billion-dollar public company. The company soon rebranded as HYBE, signaling a shift from music label to global entertainment platform. For early investors, shares in HYBE became some of the most coveted in Asia, their value tied to the relentless rise of BTS and the vision Bang Si-hyuk had set in motion. Access to HYBE's pre-IPO shares was tightly guarded. Only a select group of institutional investors, including TAC Investments, Blackstone, and KKR, were invited into the private placement in July 2019. Samsung Securities, acting as lead underwriter, prepared a confidential placement memorandum outlining the share terms, priced between 150,000 and 200,000 won, and bound by a 12-month lockup. Early investors, many of whom had backed the company before BTS's global breakthrough, received these documents stamped not for public distribution. Inside the private placement meetings, the mood was optimistic but cautious. In July 2019, an internal email circulated to all participating investors that said our strategic focus remains on expanding the Big Hit ecosystem. An IPO is not being considered for at least the next 18 months. In September 2019, during a roadshow, the company's CFO told the room the market environment is not yet conducive. We expect to stay private for the foreseeable future. These assurances were repeated in follow-up calls, even as internal preparations for a public listing had already begun. Subscription forms were submitted through a digital portal managed by Samsung Securities. Investors were promised the right to purchase additional shares if the IPO price ever exceeded their private purchase price, a clause buried in side letters. All buyers agreed to a 12-month no-sale period, with only narrow exceptions for transfers between qualified funds. The mechanics seemed routine, but the language around IPO timing was explicit. no immediate plans, no public offering on the horizon. Yet, board minutes from April 2020, which were never shared with these investors, showed the company had already resolved to pursue a listing. For those locked into their private deals, the gap between what was said and what was planned would soon become a source of doubt and anger. Confidential side letters prepared by Bae, Kim, and Lee outlined a profit-sharing formula that would later become the centerpiece of controversy. These agreements, signed in the months before HYBE's October 2020 initial public offering, specified that a private vehicle tied to Bang Si-hyuk would receive 30% of net profits generated from the public listing. The arrangement sat alongside the standard private placement contracts, but its terms were not disclosed in the main prospectus or to the broader pool of early investors. When HYBE shares debuted on the Korea Exchange, the numbers were staggering. The initial public offering raised nearly 1 trillion won, with shares opening at 135,000 won and closing the first day at 144,000 won. Within hours, the value of pre-IPO shares had soared, and the proceeds from the offering began to flow. According to media estimates, the profit-sharing clause yielded Bang Si-hyuk's private vehicle an estimated $136 million, converted from won at the official exchange rate. The payout was structured to move through a series of intermediary accounts, making it difficult for outside observers to track the full amount in real time. For the select group who held side letters, the public market surge turned paper promises into cash windfalls. But for early investors excluded from these arrangements, those who had sold their shares at lower valuations based on assurances that no initial public offering was planned, the outcome was far different. The mechanics of the side letters ensured that a single confidential contract could transform a founder's paper stake into a personal payday, even as the rest of the market cheered HYBE's blockbuster debut. The structure and the secrecy around it would soon fuel anger among those left on the outside. The initial public offering windfall did not bring celebration for everyone. Within weeks of HYBE's stock market debut, a group of early investors began to speak out. Their stories, detailed in sworn affidavits, described how they were persuaded to sell their shares at a fraction of the public price, relying on repeated assurances that an initial public offering was not in the works. For some, these decisions meant missing out on gains that could have changed the course of their families' lives. One investor, a founder of a small Seoul-based venture fund, described in his statement how he liquidated his holdings in late 2019 after a direct call from HYBE's finance office. He wrote that he was told to expect steady growth, but no listing for at least another year. Others recounted similar conversations, backed by email threads and meeting notes, all echoing the same message: stay patient, stay private. As news of the profit-sharing side letters and Bang's personal payday spread, frustration spilled into public view. By early 2024, more than a dozen investors had signed affidavits and submitted them to the Financial Services Commission. Their collective complaint accused HYBE's leadership of misleading communication and unfair advantage. The Capital Market Investigation Deliberation Committee, a special panel within the FSC, took up the case. On July 7, 2024, the committee voted to refer Bang Si-hyuk and 3 other executives to state prosecutors for possible violations of the Capital Markets Act. The official referral cited unfair trade practices and included as evidence the investor affidavits, internal emails, and transcripts of private calls. For small investors, the stakes were personal, lost savings, missed opportunities, a sense of betrayal. For regulators, the case raised alarms about how far private assurances could stray from public obligations. The referral to prosecutors marked the moment when investor anger became a matter of state scrutiny, setting in motion a legal process with consequences that would ripple far beyond the walls of HYBE. Prosecutors delivered their most direct evidence in May 2026, submitting a formal arrest warrant application to the Seoul Central District Court. The filing included 4 exhibits, each labeled and cataloged for the record. Exhibit B contained a signed agreement between Bang Si-hyuk and a private equity fund, specifying a 30% profit share tied to HYBE's initial public offering proceeds. Attached to Exhibit C were bank transfer records documenting the movement of 400 billion won to an account registered in Bang's name in December 2020. The paperwork traced the funds through intermediary accounts, each transaction time-stamped and cross-referenced with the confidential contract. Prosecutors argued that these documents revealed not just the existence of a private deal, but the exact flow of money from HYBE's public windfall into a personal account. The court's docket listed these exhibits as primary evidence, setting the stage for a legal confrontation that would test the boundaries of corporate disclosure and insider gain. HYBE's official stance has remained unwavering through the controversy. In a press release, a company spokesperson said that all transactions were carried out legally after careful legal review. The company maintains that the profit-sharing arrangement was a standard compensation agreement, fully disclosed to the board and compliant with Korean securities regulations. Market analysts, however, point to past enforcement actions in South Korea, such as the 2018 KakaoTalk insider trading case, as evidence that even technically legal arrangements can draw scrutiny if they blur the line between fair disclosure and insider advantage. The debate has widened beyond HYBE itself, raising questions about transparency and accountability for all companies navigating Korea's fast-evolving capital markets. As the investigation unfolds, the case has become a touchstone for how much trust investors can place in private assurances and whether current disclosure rules are enough to keep powerful founders in check. Today, billion-dollar IPOs reshape lives in seconds, sometimes behind closed doors. As regulators struggle to keep pace, trust in markets hangs by a thread. When fortunes can turn on what's disclosed and what's concealed, accountability isn't just a legal issue, it's the future of fairness itself. What do you think?